Well, welcome to our weekly High Rock video. This is for our clients, our private clients, but obviously anybody who is able to listen, we're happy to have you join us. We're going to talk about the global economy, we're going to talk about financial markets and the world of wealth management and how this all impacts our decisions for the investments we make on behalf of our clients and ourselves. And I'm Scott Tomlinson, and with me is the founder of PyRock, Paul Tepsich. And we have a website at www.highrockcapital.ca if you all are more interested and would like to check out the website. So we have three models in our client portfolios. Each client will have a portfolio that is very tailored to them with specific percentages, allocations toward each of these models. But what we like to do each week is talk about what's going on in these models, give our clients a little bit of an update. So Paul, fixed income. I know that we've been closely watching what's going on in the U.S. about high yield.
Yeah.
And how does that relate to some of the things that we've got going on today?
We can talk about high yield in 1 second. Let's just whip through maybe all three pie charts and describe briefly what's going on and what changes we've made. Fixed income, we haven't really made too many changes at all. We still have a pretty balanced portfolio within fixed income, from government bonds right down through into high yield and preferred shares. Global equities, we haven't made too many changes yet. We do think the global equity markets in general are fairly overvalued, as most of our listeners know. In tactical, we have made some changes. We have taken some profits on one oil and gas stock, looking to rebuy it, which I tried to do this morning actually and just missed out. We'll try again. We mentioned, I think, last week we took a position in General Electric in the U.S. That stock has been absolutely hammered. It is one of the Dow 30 components, and they had an investor day last Monday and prompted quite a bit of selling. So we have taken a small to medium-sized position in General Electric. We are still monitoring a few items here, and in general, on the tactical side, and I just showed Scott this morning, some of these oil stocks are still trading very, very cheaply on a cash flow basis, given where oil is and where what's called the oil strip, where they can sell oil into the future. It produces cash flow that the stocks are just trading at very cheap multiples. So it's something we want to continue to layer in as time goes by. So we said we would talk about high yield. The U.S. high yield market has actually been getting hit. It's popped up a little bit. And what you see on the chart in front of you is, in white, is actually a U.S. high yield ETF called HYG. There are two large high yield ETFs in the U.S., HYG and JNK. HYG is represented in white, as I said, and the S&P 500 is in yellow. And this is over a 6-month period, or 11-month period, year to date. And you can see how the S&P has continued to gravitate up, but we had a big sell-off in U.S. high yield, and certainly in HYG. Now, actually, I won't even get more complicated about the basis and the differential between the high yield market and HYG and JNK. But nonetheless, in general, the high yield market over the last 2 weeks has really been hit pretty hard, and a lot of it in healthcare and telecom. And the Canadian high yield market's been quite stable since. And as you can see, the high yield market has recovered a little bit in the U.S. But it's something we do watch, and we talk about it. We've talked about it in the past. Bonds lead capital markets, and there's really one reason for that, because it's institutionally traded. And we would like to think that institutional money managers do a lot more research than retail money managers. So we pay attention to government bonds. We pay attention to corporate bonds like high yield. That's why it's important to us.
Now, a client looking at their monthly statement, looking at a list of all of the different securities that they own, especially the ones under fixed income, they'll see a line that basically says the name of the company, It says the actual coupon
yeah.
interest that they're receiving semi-annually
And the maturity.
and the maturity date.
Yeah.
So for those clients, when you are looking at your statements and you wonder what all those numbers are, that's basically the high yield bonds. And of course, the interesting thing, and one of the things that we think is important, is not only the fact that they generate good regular interest payments and pay you to hold them, but also, of course, and because Paul does a great deal of research on these companies, we think there's some value in them as well, right?
In many cases, yeah.
Yep. Okay. Let's talk a little bit about the global equity market, because again, we continue to be and want to be underweight in our exposure to the global equity market. We think that there is, and it's been a long uptrend over the last couple of years, since the bottom in March of 2016, and now we're seeing this lower movement that's gone from lower left, upper right, but we haven't really done much testing of this channel, have we?
No, I mean, the last time we tested it looks like about a year ago during the U.S. election, so we could be due for a test of the bottom. It looks like to me it's in the middle of the channel. I mean, it could drop down and test the bottom, or it could start moving higher again and surprise absolutely everybody, including us.
We have to be always erring to the side of caution.
We do,
because we are conservative in that general manner.
Yep.
But importantly, we also have to look for opportunities too. And this is something that potentially can be an opportunity, but we want to make sure when we buy it, we want to buy it at
we want to be patient.
the right price, right?
Yeah.
Absolutely. Okay, last week we got the Canadian Consumer Price Index and all of the different indices that the Bank of Canada monitors, specifically the Consumer Price Index year-over-year change as of October to October came in at 1.4%. And now that means that all of the items in the index, various items, of course, and something that's important to keep in mind, I think, for all of our clients is, we do look at this index when we determine what we're going to use as an assumption in your wealth forecast. We want to monitor how prices are changing, but it has a lot to do with not only what you're consuming. As you can see, different components will adjust quite differently and add and take away from overall inflation, but it's also where you live. And you can look at this particular graph and see that if you lived in Prince Edward Island for the year ending September, you were getting inflation up close to 2.5%. That's changed considerably year to year in October. But if you live in Saskatchewan or live in British Columbia, obviously you're looking at a bit of a higher rate of inflation.
Yeah. So it matters not only what you consume, but where you live.
Exactly. So,
but in general, inflation is still near the lower end of the Bank of Canada's targets. Right?
Absolutely, and of course, this chart shows the range, shows in blue the total price, and then all the little various indices that the Bank of Canada uses to try to get to what they call the core, and they actually want to take out more volatile consumer items out of the index.
Like what?
Well, gas for one, because gas prices are oil and gas prices. Food is another item.
Food and energy.
Food and energy. They'd like to take that out as well.
Maybe they should take out taxes.
Well, some of these they actually do take out some taxes, right? But some of the components they actually take out if they have reached a certain level of volatility. So if clothing, for example, is highly volatile, they'll actually extract that from one of their indices. So, but the key is that they're monitoring what we call the core, and that core is what will help them determine whether they're going to raise interest rates or not. And right now, with the Bank of Canada's targets, or the inflation at the lower end of the Bank of Canada's targets, that means that we're in all likelihood not going to see much in the way of interest rate increases coming. But that also leads us to something else that we've been monitoring closely for our purposes. Well, for our purposes, right? Because we follow what's happening in what we call the yield curve, and that's the spread between short-term interest rates and long-term interest rates. So in Canada, we've seen that yield curve start to flatten. And as we've been saying, a flattening of the yield curve historically has been a precursor to recession. We want to be monitoring these things very closely. It's happening in the U.S. at a much quicker pace right now, as interest rates are expected to rise in the short term in the U.S. Longer term rates are coming down because inflation just isn't a bother. And as you can see from this chart, as we showed it last week, and we may show again in the future, but we are definitely moving closer as we get beyond or to the later stages of the cycle, the economic cycle. We're moving closer to a flattening yield curve.
And I would add on this chart, which shows the U.S. 2-year to 30-year curve in yellow and the white blue shaded areas of the last 3 recessions, that the yield curve is flattened like that the last 7 recessions. Mitch, maybe we could show that next week. I'm not sure if we can pull that chart up or not, but we should look at it.
Get a longer chart, longer data chart.
This yield curve is very important to us.
And on that note, let's talk about what's been happening as far as debt. Now, latest data on U.S. household debt shows record levels, again, this time being led by student loans in the red and auto loans in the green on this particular chart. Now, debt is fine, except for the fact that if interest rates go up, as they have been in the United States, and there's a borderline ability to repay that debt, this debt servicing aspects of it get too extreme, then we start to get into delinquencies. Paul, maybe you'll talk a little bit about that.
But the other side too is, just to pause on that chart, is we also have to look at debt to disposable income. Right. So if income levels are rising, they can support some of that debt. But delinquencies are certainly rising as well, as we can see. I mean, credit card delinquencies in blue look like they're rising a little bit over the last year or so. Student loans, which are they've been high for a long time. I mean, nominally, student loans are huge. I think that could be a potential bubble in there. That could be really problematic. So we do want to focus on delinquencies for sure, which simply means those people who have stopped paying interest on their loans in these various classes.
Well, what would potentially make a recession more severe is the fact that there would be this pressure on the household.
Yeah.
And that's something that we want to be careful of, because we don't want to see another 2007, 2008 type of financial crisis. But we do have to monitor all the things that go into what is creating that debt and what the potential implications are in the future when the economy turns down. Okay, well, we look at all of this data. We look at for short-term opportunities. Hopefully that's what allows us to determine when there is an opportunity in the market. But we also take a very long-term perspective, multi-year perspective on our clients' wealth. That's why we prepare wealth forecasts for our clients. So it is always important for us to be working very much towards your longer-term goals. All right. Well, thanks again for joining us this week. We look forward to entertaining you next week with our next version. Hopefully, we're getting a little better at this video thing. It's a bit of a new gig, but we're having a little bit of fun trying to figure it all out. And please feel free to. We have received some great feedback from our clients and other viewers. So please continue to feel free to send it in. Thanks so much, and we'll be back next week.